Singapore dividend investors often chase the fattest yields. That looks smart on paper, but it backfires in practice. High yields can mean falling earnings, asset sales, or debt-fueled payouts. The goal is not the highest yield today. The goal is a payout that can last and grow across cycles. In this video, expect a clear, SG-focused playbook. We'll use my 7-point dividend durability system to separate durable payers from dividend traps. You'll get specific buy, hold, avoid calls, CPF and SRS positioning, and a simple checklist to stress test any SGX dividend stock. This episode is adapted from my latest in-depth Substack deep dive. I'm Iggy from the Investing Iguana, Singapore-based investor and educator, breaking complex finance into simple frameworks for better decisions, especially for SGX, CPF, and SRS strategies. Here's the roadmap. The dividend quality crisis in Singapore, Iggy's 7-point dividend durability framework, top 5 SGX dividend champions for September positioning, the dividend disasters to avoid, strategic implementation for Singapore investors, market outlook, and dividend sustainability, and the dividend investment imperative. Let's set the scene. Singapore's market offers strong yields, but payout quality is mixed. Some firms fund dividends from real cash flow and low leverage. Others rely on capital top-ups, fee deferrals, or one-offs. Screeners can't catch this. It tempts investors into weak income. Anchor to one key idea. A 4-7% yield from a cash-rich, conservatively run company beats an 8% headline from a stretched balance sheet. That bright green yield on the app is often a warning, not a gift. If this was a live chart, I'd show you a simple table. Signals like yield above 7%, payout above 80%, and special dividends. The takeaway is clear. High yield with thin coverage is fragile. Ask yourself, would a steady 5% that survives recessions beat an 8% that gets cut next year? To solve this, use one strict system. This is the system I use every month to rank SGX payers. Yield sweet spot is 4 to 7%. Above 7% triggers caution unless cash coverage is strong. Payout ratio at 50% or below is best. 50 to 80% is workable. Above 80% is risky. Cash flow coverage, aim for free. Cash flow at least twice the dividend. Leverage, lower net debt equals safer payouts when rates move. Earnings stability, predictable sectors, and margins support steady DPS. Track record, 10 years or more, paying across cycles shows intent and discipline. Red flags, asset sales to fund DPS, capitalized costs, or unusual financing. If this were on screen, I'd show the 7-point scorecard table with each factor and how it scores. The insight is balance. Never let one shiny metric override 5 weak ones. Before buying, ask, is this a 4-7% yield with real cash and room to breathe? With that lens, let's rank the current crop. These 5 names clear the bar on durability, coverage, and sensible yield. They favor compounding over showy yields. Bukit Sembawang Estates, ticker B61, stands out with a score of 7.0. This is rare quality. Yield sits in the mid-4% sweet spot. Payout ratio sits around single digits. That's almost unheard of. It signals a huge buffer and room to reinvest. The track record runs long. The balance sheet and culture are conservative. That keeps dividends steady through cycles. Takeaway, a best-in-class dividend name, buy on dips. Quick question, would a near 5% yield with a massive cushion calm the nerves in a choppy year? Next, United Overseas Bank, ticker U11, scores 6.0. UOB balances income now with capital strength for later. Yield near 5% with payout in the low 50s is exactly what CPF and SRS investors want. The bank has a long dividend culture and strong capital ratios. Local banking economics here are stable. Risk controls are strict. Takeaway, core anchor for CPF and SRS income, accumulate or hold. Think about it. Do CPFOA funds deserve a reliable 5% with a prudent buffer? UOB fits that slot. Next is CapitaLand India Trust, ticker CY6U, score 5.0. This is the income growth bridge. Yield ranges mid 3% to high 5% depending on period. Payout is prudent. It has a 13-year operating history. India exposure adds a growth lane, but mind rates and FX. Takeaway, diversifier with steady income and upside, buy or hold for mix. Check yourself. Does a small position that blends income and growth help round out the portfolio? Pacific Century, ticker P15, scores 4.0. The 4 and 5% yield appeals, but the payout is not backed by steady profits. Negative payout ratios signal losses. Cash offers a short-term buffer. Track record is shorter. Takeaway, tactical only, small sleeve, hold if in. New money should nibble. Ask, is this a satellite or a core? For income reliability, it's a satellite at best. Keppel DC REIT, ticker AJBU, comes in at 3.5. The structural growth story is real. Data center demand rises long term. But the payout cushion is thin. Payout sits in the mid-80s. That leaves less room for shocks from rates or contract resets. Takeaway, higher risk satellite income, size modestly, hold or balanced buy if comfortable with REIT dynamics. A thought, if rates drop, it breathes easier. If not, the cushion feels tight. Size it with care. If you want all the full charts, checklists, and written playbook, grab this post on Substack. Link is in the description below. 2 names sit on the warning list. Thackral Holdings, ticker MEK, with a headline yield near 8% and weak cushion. High yields like this often come right before cuts. Bund Center, ticker BTE, about 7.7% yield with payout above 100%. That is not durable through a down cycle. If this was on screen, I'd show the dividend traps table. The message is simple. Payout above profits equals fragile dividends. Protect capital first, income comes next. Quick recap. Avoid a size very small. Don't let headline yield override sustainability. CPF and SRS fit. For CPF OA, aim for durable 4 to 6% that beat OA rates at low risk. UOB and Bukit Sembawang are perfect anchors. For SRS, consistency matters due to early withdrawal penalties. Blend Bukit Sembawang, UOB, plus a small slice of CL India Trust for growth. Portfolio construction. Core comprises 60 to 70% Bukit Sembawang and UOB. Diversifiers make up 20 to 30%, such as Capital Land, India Trust. Tactical is 5-10%, like Pacific Century and or Keppel DC REIT. For risk management, check payout ratios each quarter. For REITs, track leverage and interest costs. Prefer cashback dividends over financial engineering. On screen, I'd show the CPF SRS positioning map and a decision checklist. The checklist asks 6 yes or no questions. 4 or 7% yield, payout 50% or less, FCF covers at least twice the dividend, low leverage, at least a 10-year record, no accounting flags. More yes answers mean more durable income. Base case is a slow but steady macro, which suits conservative payers. If rates ease, REIT cushions improve. If rates stay sticky, low leverage and low payout names win. Either way, the 4-7% sweet spot offers the best trade-off. Chasing 8% plus feels good now, but it often ends with cuts and capital loss. Ask yourself, would a portfolio that holds its DPS through a downturn make sleeping easier? If yes, stick to the framework. Dividend investing here is about durability, not dazzle. Focus on coverage, conservative balance sheets, and long records. Bukit Sembawang and UOB show that steady beats flashy. Build the base with quality, add selective growth for upside, and keep the risky high yielders small, if at all. My money goes to reliability first. For CPF and SRS, I size Bukit Sembawang and UOB as the core. I add Capital Land India Trust for measured growth. Keppel DC sits in a small satellite sleeve. Pacific Century is tactical and small. Thackral and Bund Center stay off the list. If rates ease, REITs get some relief. If rates stay high, low payout, low debt names keep paying. The framework holds across both paths. Thought for the week. What would it take for you to switch from chasing yield to buying durability? If the answer is one nasty dividend cut, skip the pain and move today. Here's the quick recap, in the same order. The crisis is that headline yield hides weak coverage. The fix is the 7-point framework for durability. The picks are Bukit Sembawang, UOB, Capital Land India Trust, with Keppel DC and Pacific Century as satellites. The avoids are Thackral and Bund Center on fragile payout logic. The strategy is CPF and SRS anchoring, core diversifier tactical sizing, and a simple yes or no checklist. Take these lessons into your SG investing journey with confidence. If this helped, like the video, share it with a friend, and subscribe for more SG-focused dividend breakdowns. For the full tables, checklists, and the written playbook, grab the Substack Deep Dive. Link is in the description. Premium members get the model portfolio, monthly rankings, and alerts.